When choosing a mortgage, will a fixed or variable rate best serve your needs? I'm Tim Osborne with tellmemortgage.ca, and in this video, I'll explain the differences so you can make an informed decision with confidence. A fixed rate mortgage is like it sounds. The rate and payments are set at the beginning and they do not change for the entire course of the term. If market rates go up, you're protected. However, if rates go down, you do not get to take advantage of those savings. But the predictable monthly payments make it easy to budget your life around, and for some borrowers, that's the peace of mind they need to be able to sleep at night. Of course, you do pay a premium for that security. Variable rates by definition can change, but typically they start at a rate much lower compared to their fixed rate alternative. Choosing a variable rate mortgage is betting that the average rate will be as good, if not better, than the fixed rate alternative. Anyone in finance will tell you you need a crystal ball to know the future of mortgage rates in Canada. I got mine online for just $7.95. Watch this. Hey Crystal, what's the future of mortgage rates in Canada?
Let me check on that.
What do you expect for $7.95? I don't even think it's real crystal. Fortunately, a 2001 York University report analyzed 50 years of mortgage data, concluding that roughly 9 out of 10 times a borrower would have been better off sticking with a variable rate rather than going with a fixed. What about the fact that 5-year fixed mortgages still have been a very popular choice in years gone by, despite those statistics from the York University report? Well, here's 2 significant reasons driving those previous decisions. First of all, risk tolerance. If a borrower or their spouse is the kind of person who's going to lie awake at night worrying, knowing that rates could go up, it's probably not worth the anxiety and the stress that it can put on a relationship. For those borrowers, probably a fixed rate is the best way to go. More importantly, prior to October 2016, borrowers could unlock significantly more purchasing power with a 5-year fixed mortgage as compared to any of the variable rate products or even the shorter fixed-term products. And that's because mortgage regulations at that time required borrowers to first qualify at a much higher benchmark or stress test before they could access those lower rate, lower term products. 5-year fixed mortgages, on the other hand, were allowed to qualify at the contract rate, which gave them significantly more purchasing power. Now, because most borrowers are looking to unlock their maximum purchasing power, a variable rate just doesn't come into the picture because it doesn't attain that goal of the maximum purchase price. In October 2016, that all changed. New mortgage insurance-related rules came into effect, which required most 5-year fixed products to also undergo that same benchmark or stress test before they could access those great rates. Now, not only did that reduce purchasing power by about 20%, it leveled the playing field. So now there's no longer that great advantage by going with a 5-year fixed. It's the same purchasing power, so now is a legitimate decision. Do I go with a fixed or a variable? Now, yes, you can still get an uninsured 5-year product, and it does allow you to access more purchasing power in many cases, but you will pay a higher rate for that privilege. A common fear and misconception is that if rates doubled overnight, payments would double as well. But that's not the case. Only a portion of your payment is interest. The rest is principal and goes toward paying back the original loan. Compare payments for a $100,000 loan amortized over 25 years and a jump from 2% to 4%. That's a 24% increase, not 100%. Similarly, a jump from 4% to 8%. It's a 45% increase in payment. Now keep in mind that kind of a jump is highly unlikely anyways. The variable rates are tied to the prime lending rate, and the powers that be meet up to 8 scheduled times a year to decide if prime should stay the same, go up, or go down. Historically, it's been very stable and changes typically only in 0.25% increments, if at all. If you're really concerned, most variable rate lenders will allow you to lock in at any time at their fixed rates available at that time for the remaining term. One last feature about variable rate mortgages compared to fixed is that breaking a variable rate mortgage usually only triggers a 3-month interest penalty. That's much less than a 5-year fixed, which can trigger a much more significant interest rate differential penalty. Hope you found today's video helpful. If you did, leave a comment below, subscribe, and share with those who might also find it helpful.